Hello and welcome to this module, which is an introduction to accounting. Through this video, I aim to cover 4 key objectives. So we're going to start off by exploring what is accounting. We'll then move on to consider the elements of the financial statements. We'll then introduce a basic template for a set of financial statements, and then we'll end with a brief little overview of the different types of business structures. Now, to support your learning, you might want to download the course notes and annotate away as you listen to this video. So let's start by understanding what accounting is all about. Now, if I asked you what is accounting, what would your answer be? You might want to pause the video and jot down your thoughts. Maybe you tell me that accounting is to account for something, and I'd tell you that you're absolutely spot on. Accounting really can be broken down into 2 different branches. And so here on this page, I've noted those 2 branches. Accounting is all about recording financial transactions, and it's also to do with summarizing financial transactions. Now, recording financial transactions is all about having a clear audit trail. Okay, so an audit trail of transactions. And really what we mean by that is keeping a record of your daily sales, your daily costs, for instance. Say I own my own bakery and I make super scrumptious cakes. I do want to keep a track of my revenue that I'm making in my shop every day, and I also want to keep a track of the costs that are involved in running my shop or in manufacturing my scrumptious cakes. So what I would do is record these transactions. We often refer to this side of accounting as bookkeeping. And actually in another video, what we will go through is basic bookkeeping and accounting for transactions. Recording day-to-day transactions is a really important task because what it does is it puts us in good stead to summarize our transactions, which really is the second branch of accounting. Summarizing financial transactions is particularly useful because what it does is it helps us with decision making. For instance, maybe my bakery is doing really well, and at the end of the first year, I want to go to the bank and I want to take out a further loan to open another bakery shop. Now, it's very likely that my bank manager is going to want to see a summary of my financial performance for the year and also my financial position, because what the bank wants to assess is my ability to pay back that loan. Summarizing financial transactions is best done through the production of financial statements. Now, in this video, we will introduce a brief template of the basic financial statements. You might also be familiar with these financial statements. We have the Statement of Financial Position, which I tend to abbreviate as SFP, so Statement of Financial Position. Some of you might be familiar with this as being referred to as the balance sheet. Now, the balance sheet really is more UK GAAP terminology. Okay, and when I refer to UK GAAP, we're thinking about UK generally accepted accounting principles and policies. We also have another financial statement, which some of you may be familiar with, and that is the Statement of Profit or Loss, which I'll abbreviate as SPL, so the Statement of Profit or Loss, or you might also be familiar with this as being the income statement. Now, as I've said, through this video, we will look at the basic pro forma for the financial statement, so we'll think a little bit more about these financial statements then. Now, much of the accounting world is governed by accounting standards. And you can think of accounting standards as really the recipe to a meal. If you wanted to make a deliciously yummy lemon tart, you're obviously going to follow a recipe. Now, that recipe offers some instructions and potentially scope for you to adjust the ingredients to suit your taste buds. Well, think of the accounting standards as doing something similar, except instead of a lemon tart, you're producing a set of financial statements. So why do I bring them up now? Well, the reason I bring them up is because the actual financial statement pro formas, they are governed by an accounting standard. And the accounting standard that governs these pro formas is IAS 1, or International Accounting Standard 1. It provides us with the guidance on how these financial statements should look and the minimum content they should include. Now, we need a standard like this that governs these pro formas to ensure there's consistency in the way that businesses are producing their financial statements, as otherwise comparability would be virtually impossible. So, before we consider the financial statements in any more detail, I think what might be useful is to actually introduce the elements of the financial statements. So, let's do precisely that. Now, the elements really can be defined as what is included in the financial statements. In other words, the items that are part of the financial statements, and they're basically referred to as the elements. We can summarize these elements really under 5 key headings, and we'll talk through each of these in turn. So, what are these elements? Well, we'll start off by thinking about assets. Okay, the A, assets. Now, assets really are items that the business owns. So, for my bakery shop example, this might be the premises that I own, where I sell my cakes from. It would include the stock that I hold and the cash that I have in my tills. It would also include amounts that are outstanding from customers. We refer to this as receivables or debtors if you're familiar with UK GAAP terminology. For instance, if I get an order for a cupcake for a big New Year's Eve party, it might be that the customer promises to pay me at the start of the new year. Now, the fact that the money is due to me at the end of the year or owed to me at the end of the year is an example of an asset because I own that money essentially. It is due to me at the beginning of next year. Liabilities, on the other hand, are referred to as items that the business owes. Now, this would typically be something like a bank loan or an overdraft. It would also include amounts that are owed to the tax authorities or amounts that are owed to my suppliers. We often refer to this as a payable or a creditor if you're familiar with UK GAAP terminology. Income really just refers to sales or turnover. Okay, so these are amounts that are earned by the business during the year. So in my example of my bakery shop, this would be the income that I earn from selling my cupcakes. We also have what is referred to as capital. Now I'll come back to capital. We'll address that in just a moment, but let's just skip over to expenses. Now, expenses refers to the costs that are incurred in generating the revenue or the income for my business, such as the cost of the ingredients, the wages that I might be paying to the shop floor staff. So I'm just going to refer to this as the cost. Now let's come back to capital. Capital refers to what is owed back to the owners of the business. Okay, I'm just going to write that down. So it's owed back to the owners of the business. So what do we mean by that? Well, with my bakery shop example, if I am the owner, any amounts that the business generates, well, it's owed back to me because I am the owner of that business. That business owes me back that amount. We call this the capital. And as you sort of progress through your studies with accounting, you'll become a lot more familiar with this concept of capital. For company structures, which we'll see towards the latter part of this video, capital is often referred to as equity. Okay, so capital or equity, interchangeable terminology really, equity typically used for company structures. Right, so we have here the 5 elements. assets, liabilities, income, expenses, and capital. Now, what you might have noticed is that there is a mnemonic that you can use to remember these elements. It's the wonderful Alice. Okay, now just to summarize, the elements are what goes in the financial statements, and there are 5 things that you will see featuring in these financial statements: assets, liabilities, income, capital, and expenses. We are going to see that assets, liabilities, and capital will feature in the SFP, the Statement of Financial Position, whereas income and expenditure or expenses will feature in the Statement of Profit or Loss. Okay, and over the next few pages, we are going to be introducing these financial statements. So I'll reiterate this again. So on to the next page, what I've done is drafted a very basic template for the statement of profit or loss. Okay. And the statement of profit or loss is always produced at the end of the year to reflect the performance of the business for the year. It is a story of how the business has performed. Now we'll see over the next page that the statement of financial position, on the other hand, is a snapshot of the business's position at a particular date. Okay, so it will reflect what the business owns, what it owes, and ultimately what is owed back to the owners of the business. So let's take a little closer look at the statement of profit or loss. And here you can see that, as the title almost implies, you want to reflect the profit or loss generated by the business at the end of a particular period. We typically start off with revenue, followed by deduction for the cost of sales. So these are the costs that are directly attributed to generating that revenue. Gross profit, okay, is what we get once we've deducted cost of sales from revenue, followed by reduction for admin expenses and distribution. Okay, now admin and distribution expenses are just a general classification that's given to expenses, and admin expenses could include multiple different expenses. Okay, so it could include things like the salary that you pay to your staff. It could include the rent that you might pay for your head office, the accountant's fees. Distribution costs might include things like the wages that you might pay to your lorry drivers that distribute goods, or maybe the rent that you pay on your warehouse where you store the goods. Now, a business is free to classify its expenses under either of these classifications as it sees fit. However, it must present the classification consistently each year. There are rules that do need to be followed if the business decides to change the classification of a cost, but in this video we won't get so bogged down in that just yet. Once you've deducted those admin and distribution costs, you do arrive at profits from operations, from which we deduct finance costs. These are typically interest on bank loans or overdrafts, and we add on what is known as investment income. Investment income is typically interest income that's earned on savings, maybe it's dividend incomes from other investments that we might have. To arrive at profit before tax, from which we deduct income tax. Okay, income tax in the UK is corporation tax. This is because a company is seen as its own legal entity, and I am here showing you a pro forma for a company structure. Okay, there are ever so slight differences if you are a sole trader or a partnership. Okay, but we won't worry about that so much so yet. And once that's deducted, you arrive at what is known as profit for the year. Now, remember, this is a statement that reflects the story of the performance for the year, and it will never ever be accumulated position. Okay, the profit is just the profit for the current period or the current year. And it's an important figure because this is carried into the statement of financial position, into retained earnings. Okay, so I'm just going to do a little arrow here and I'm going to abbreviate RE to reflect retained earnings. And I'm going to bring this up again when I show you the pro forma on the next page. An important thing to note is that this really is a sample pro forma, and there are variations on this, okay, but generally the guidance that's given in IAS 1 draws along a pro forma similar to what I've shown you here. Which brings us on to the SFP, okay, the Statement of Financial Position. This is always an as at date. And what we mean by that is that it reflects the position of the business as at a particular point in time. And what we show in the SFP are the assets. Okay, this is what the business owns. We show the liabilities, which is what the business owes. And ultimately, we have equity or capital, which is what's owed back to the owners of the business. And that should hopefully make sense. What the business owns, okay, take away what you have to owe, i.e., to your bank and overdrafts and payables, etc., should give us what the business has left over to give back to the owner. Okay, and we'll draw on this as an important idea in another video. Okay, the accounting equation, and we'll touch on that in another video. Now, we always start off by showing our assets first, and assets are typically classified as non-current or current. Now, the idea of something being non-current is simply that it's going to be in the business for more than 12 months, okay, i.e. they're long-term. So we typically have property, plant and equipment. So for instance, in my bakery shop example, this would be the premises that I own, maybe the vehicle that I might have to deliver my cake orders, and maybe I've also got, let's say, fixtures and fittings or other types of computer equipment, all of which would be amalgamated in that heading, property, plant and equipment. Now, current assets, I guess, then, will be those that are going to be changing over the next 12 months. And these are typically assets that are to do with the business's operational cycle. So we typically have things like inventories or stock. We have trade and other receivables. So we touched on the idea of receivables being amounts owed from credit sales. And we have cash and cash equivalents. And a summation of non-current assets and current assets should give us total assets. Next, we have equity and liabilities. Now, we're going to learn a little bit more about equity in another video, so I'm not going to get too excited about the idea of ordinary and preference share capital just yet. But remember, think of this as what the business owes back to the owners. We did mention retained earnings on the previous page. So retained earnings here, I want you to realize, is simply an accumulation of all the profits that have been generated by the business year on year. Okay. Any profits that are given back to the owners in the form of dividends, they would have been deducted from retained earnings. Okay, and we'll worry about that in another video. Finally, we have liabilities, and just like your assets, we do separate out the liabilities between non-current and current, and a very similar idea. Non-current liabilities are going to be those that are not due until post 12 months or more. Okay, like a 10-year bank loan, for instance. And current liabilities, those that are due in the next 12 months. Okay, now your non-current liabilities typically include things like a bank loan, whereas your current liabilities will include trade and other payables. So we spoke about other payables as being amounts due to our credit suppliers, and maybe you've got some tax outstanding that's due to the tax authorities. Again, this is a sample pro forma, and as you work through accounting, these are pro formas that you should become very, very comfortable with and in producing as well. Now, finally, to end this video, what I'd like to do is quickly introduce to you the different types of business structures. Okay. Now, when we think about businesses, they do come in different shapes, different sizes. They have operational scales that vary as well. Okay, much of the accounting rules between the different business structures are very, very similar. Okay, and so, when we go through the video on basic bookkeeping, whether you're looking at a sole trader, a partnership, or a company, they will be accounting in very much the same way. There are just the odd few differences. So let's just talk about firstly a sole trader. Now, I guess the giveaways in the phrase sole, we are thinking about an individual that owns and manages a business. So, what we typically see here is that the owner and the manager are essentially the same individual. So in my bakery example that I've been giving you through this video, that would be an example of a sole trader. I own that bakery, I run that bakery, it's my own business. It would be a sole trader structure. Okay. Now, being a sole trader doesn't necessarily mean that I can't employ any other employees. It totally means I can. However, when we think about sole, we simply mean that the owner is an individual that is running that business and managing it as well. Okay. Next, what we have is a partnership. Now, you can almost think of a partnership as being multiple owners who are also the managers. And I guess the benefit of being in a partnership structure is that you're sharing out your risks as well as rewards. Okay, so you've got partnership structures that are very common across professional services. So accountancy firms tend to operate as practices. Dentists or dental practices tend to be partnership structures as well. The most complex of structures tends to be your company structures. In the eyes of the law, the company is seen as a separate legal entity. Now, the interesting thing here with a company structure is that the owner, which is often referred to, or the owners, is often referred to as a shareholder and may not necessarily be the one running the business. I'm not saying that's always the case because you can get private companies where, you do have the owner and the manager being the same. However, generally speaking, if you think about Apple, Facebook, Google, okay, the shareholders invest in the business. But they are not the ones that are running that business. Okay, what they would do is elect directors, okay, to run that particular business. And we're not going to get so bogged down in the legality of how these structures work and how they're set up. You simply just need to appreciate that businesses do operate in different ways. Now, much of the videos that I create will be focusing on company structures. And like I say, there are very few differences in the way we account for a sole trader, partnership, and a company. Yes, there are loads of other types of business structures like charities and not-for-profit organizations, but they tend to be specialist accounting rules there, which we're not going to get bogged down in the videos that I cover. Right, so that's the end of my video, okay? And our key objectives were to identify what is accounting. And we've basically said that this is all about recording and summarizing transactions. We then moved on to consider the elements of the financial statements. And the elements of the financial statements are simply the items that feature in the financial statements. So we've got wonderful Alice to help us remember this. We've got assets, liabilities, income, capital, and expenses. We then moved on to introduce the financial statements, and the two key ones that I'm hoping you have sort of familiarized yourself with through this video is the statement of financial position, the SFP, showing a snapshot of the business, and the statement of profit or loss, showing the performance and the story of the business for the year. Finally, we've ended with the different types of business structures, sole traders, partnerships, and company structures, focusing on the idea that generally with company structures, the owners are not necessarily the managers of the business. Right, hopefully you've taken something useful away from this video, and I look forward to having you listen in on another video. Thank you.